Hello and welcome, everybody. Happy Friday. I hope everyone is having a good week, and I'm not going to give too much of an introduction. Today is definitely a much more difficult situation than most of the very happy and cheerful webinars. There's been a lot going on this week. Much of it is tragic. It's horrible to see what's happening in the world, but we're living in this world, we're living history as it happens, and it's my job to be here to tell you about how it affects us. So I'm not going to give too much of a cheerful introduction to today. I just want to get straight into what I have to talk about. So thank you all so much for understanding. Let's talk about what we have to share today. So today's topic is going to be on the current events surrounding the Russia and Ukrainian war, as well as how this affects us here in the US with our stock market and our economy. Disclaimer, we are going to talk today about stocks. We're going to look at wars in the past and oil conflicts in the past to try and understand what they may mean for us today. But past results cannot guarantee future performance. We have no idea how this is going to end up, both as the war itself, but also our economy. So we're going to take a look at what's happened in the past to try and understand, but more so than ever, past results cannot guarantee what is going to happen in the coming weeks and months. Second disclaimer, I do need to say this. Today, we're going to be talking about the war in Ukraine. This is something that was started 2 days ago. The invasion began 2 days ago. So this is very much current events, things that are happening by the minute today. And I'm not a reporter. I'm not here to cover the news. And also the news, it's hard to know what is true, what's not, what is propaganda and what's not. And I'm not here to tell you what to believe or what not to believe. I want to talk today about the dollars and cents. I want to talk about the money. I want to talk about the stocks. But before I do, when I'm talking about all of this, please remember that we're talking about dollars and cents, but there are real lives that are being lost or displaced as a result of this crisis. The situation is horrible, and we can only hope it gets better. But many of us, and myself included, wonder what can we do to help. So if you're confused and you don't know where to help, or you want to help but are not sure what group to reach out to, I've done a lot of research and I've found one group in specific that I want to post the link for. By no means do you need to make a donation, but if what's going on right now upsets you and you want to contribute and help out, this is a great way to do it. So I will be putting the link in chat right now for the CARE group. They are extremely well respected and directly are helping out with the crisis that is going on in Ukraine. So if you want to, I would highly recommend donating to a reputable cause. And this is one that I've gone through and made sure is reputable, so you know your money is really going to help those who need it the most. So let's get into today's topic. I have no idea why it's not showing up as the slides, but it should fix itself in a minute here. So today's topic is about the current war going on between Russia and the Ukraine. Ukraine, not the Ukraine. There is a difference, and it's important to say Ukraine, not the Ukraine. Over the past few weeks, Russia has been getting increasingly more aggressive towards the country of Ukraine. They have stated that the reason that they are going into Ukraine is for peacekeeping operations. They are saying that the government of Ukraine is led by Nazis and that they are going in to fight fascism and liberate the people of Ukraine. That is the reason that they give. I'm not here to talk about that. I'm not here to talk about the politics of it. There are plenty of other places that do that far better than I can. What I want to talk about is how this affects the economy of, well, we are a global economy. So how does it affect Russia, which also affects Europe, which also affects us here in the US? So before we get into what does this all mean for us in the US, we first need to start off with Russia. So let's take a look at Russia's economy, because that'll give us a good idea of where are they at and why is the world responding in the way that it is. This data is coming from a reputable source. I will share the source at the end of the slide. But in 2019, Russia ranked number 13 in the world for exports. They exported, which means they produced things in their country and then sent it out to other countries. $407 billion worth of exports. Import-wise, they also are heavily involved in importing. In 2019, they were ranked 21st in the world for imports, with just short of $240 billion worth of goods imported. For what they export, there's a reason that they're ranked number 13. They are heavy suppliers of oil. By going in order of their top exports: crude petroleum, refined petroleum, petroleum gas, coal. All of those are oil or energy-related things. And then wheat. Funny enough, they're one of the largest suppliers worldwide of wheat, but that's not what the important part is here. The important part is the oil and gas products. Russia primarily exports these goods to European and Asian countries, including China, the Netherlands, in order of their biggest, smallest, by the way. China, Netherlands, Belarus, Germany, and Italy. And they import a lot of their goods from China, Germany, Belarus, the US, and Italy. So what does this mean? What does this tell us here? This means that they rely on trade. Yes, their biggest trade partner is China. China is also one that has been the least kind of proactive with how they're responding to this war. And understandably so. When you rely on Russia for your oil and natural gas, and they rely on you, that's a lot of kind of helping each other, or interdependence, that they're not going to want to break. Germany, Italy, the US. Those are three countries that very much are not happy with what's going on and are looking for ways to punish Russia without going to war for their actions. All of this data was provided by oec.world, and after the webinar, I will have the link for all of that data down in the description. But why does this matter? Why did I just talk a lot about the Russian economy? We're here to talk about the US stock market, not the Russian economy. Well, this is why. As of today, February 25th of 2022, the majority of developed nations, the G7, which are the 7 largest economies in the world, stated that they will not go to war with Russia. No one wants to see a conventional war fought in 2022. There's too much at stake, and really, no one wins. There's this idea of mutually assured destruction, which means in a war that turns hot and nuclear, there's no winners. Everyone loses. So we need to avoid that. So instead of going to war, instead of trying to fight Russia directly, the global powers, the US, the EU, and other global superpowers such as Japan, are using economic punishment, which carries the name sanctions, to try and hurt Russia's economy. Now, on the last slide, I talked about how Russia's economy is number 13 in the world for exports. They export a lot of goods, and the majority of their goods are oil and natural gas. I'm sure all of us here follow the stock market pretty closely and can tell us that, yeah, energy has been a booming market in recent weeks, and really a lot of that has been the result of oil and gas prices skyrocketing. Russia serves to profit from that. They have a lot to gain when oil prices go up. But just because Russia is in the top 15 for exports, that doesn't mean they're a strong economy. To see how strong an economy is, we've got to look at another number. It's called GDP per capita. Big fancy words for saying how much stuff does that country produce and export divided by how many people they have. So how much stuff do they make divided by how many people they have. So while Russia ranks number 13 in exports, it ranks 82nd in GDP per capita. That means that they're exporting a lot of stuff, yes, they're producing a lot of stuff, but as far as how much money per person they're getting, they only place 2 places above Cuba, about 5 to 7 places above Mexico, and right below China. That is not a strong economy. That is not a global superpower for the economy. If you go back to a webinar that I did a few months ago, where I talked about the idea of developed versus emerging markets, we talked about how China is still considered to be an emerging market because their GDP is very, very low. Yes, they produce a lot of stuff. Yes, they export a lot of stuff. But the average person is not rich. The average person's quality of life is not the middle class or even the middle lower class of America. So this is very much a country that is not booming, and their economy relies on oil. So when we're talking about how can we punish Russia, or how can we get back and fight Russia without going to war, this idea of sanctions is very important. So what do the sanctions actually do? Well, it depends on the type of sanctions. Some of the ones that we're seeing right now, and are easily the simplest to set up, are trade. There's other ones that are financial related, but those are much more difficult, and I'll talk about why in just one moment. Trade-wise, so looking at the trade restrictions that have been used so far, Germany, who is one of Russia's largest buyers of oil, has canceled a pipeline deal with Russia. That pipeline was called Nord Stream 2, and that was one of the first things that was taken away from Russia when war was declared. Japan has stopped selling microchips and technology devices to Russia. The US has stopped exporting chips and other technology products to Russia, and many, many, many more. Europe, Japan, and the US all have placed trade restrictions on Russia, and what restrictions they're adding are going up by the day. Now, here's the biggest sanction that is currently being discussed: SWIFT. This word you might not have known existed before yesterday or today, but it's one that you're going to hear about more and more and more over the next few days because of how important it is. And the thing about SWIFT is this doesn't just damage Russia. this damages everybody. So let's try and understand a bit more about what SWIFT is, so we know why it's such a big deal if it gets taken away, for not only Russia, but for us too. SWIFT is an acronym. It stands for an entire big thing. It stands for the Society of Worldwide Interbank Financial Telecommunication. Wow, I'm really glad they made that into an acronym. SWIFT rolls off the tongue a little bit easier. SWIFT is centered in Belgium, and it is used by over 200 countries and 11,000 financial institutions around the world. This is how nations communicate. They don't give and send money over SWIFT. It is how they communicate. It's how economies communicate with each other. Because SWIFT is so important and it is so widely used, cutting Russia off from SWIFT essentially cuts them off from foreign currency. It cuts them off from US dollars, British pounds, cuts them off from almost everything. And most importantly, cuts them off from the US dollar. So, again, I don't want to try and predict what's going to happen. That doesn't really help us here. Everyone can have a guess at what's going to happen, and only a few of us are going to be right. So instead of trying to tell you what might happen, let me tell you about what's happened in the past. Because we have, and by we I mean the global community, have done this before. We've cut a nation out of SWIFT. So let's look at what happened there. Because, in fact, this other case that we can talk about is another country that relies on oil and other countries buying their oil to survive: Iran. Back in 2012, there was concern in the global community about Iran building up their nuclear capabilities and working towards building what might have been a nuclear bomb, might have been nuclear energy. Regardless, the international community was worried about what Iran was doing with their nuclear capabilities, so they put in sanctions. The sanctions were Iran got booted out of SWIFT. What did that do to their economy? Well, when you can't transact with foreign countries, when you can't exchange currencies between banks very easily, it makes trading a lot more difficult. In 2012 alone, Iran lost 50% of their oil revenue and 30% of their foreign trade. That is huge. We are talking here billions of dollars. So that is the kind of impact that we might see if SWIFT boots Russia out. Now, where are we at with all of that? Again, we're seeing a lot of this changing by the minute. But as of right now, many European countries have agreed. France, Germany changed their mind, so now Germany is in favor of booting Russia from SWIFT. So Italy, Germany, France, the UK, and the US have all expressed interest, and I believe Turkey as well, but I'm not 100% on that one, have agreed that Russia should be removed from SWIFT. So how would this affect the world? If Russia was removed from SWIFT, what would happen? Well, here in the US, not very much. Not very much relative to what might happen elsewhere. The majority of this, it's going to hit Europe. Europe is very, very reliant on Russian oil. None more so than Germany. Germany relies on Russian oil. It is the sole reason that until literally 3 hours ago, it is 4:20 on February 25th. Until about 2 or 3 hours ago, Germany wanted no part of kicking Russia out of SWIFT because that would mean that they can't buy or can't easily buy Russian oil. To put a number to this, Europe relies on Russia for oil to the tune of 37% of its oil in 2020 coming from Russia. If you expand this to the EU only, it's 40%. Sorry, correction. Europe's trade outside of just oil is 37%. 40% is gas. So gas and oil, EU relies on 40% of their oil and gas coming from Russia. Because of this, obviously, that's a huge amount of oil and really reliance on Russian oil. So many European countries, no more so than Germany, didn't want to kick Russia out because if they did, they're going to get cut off from 40% of their oil and gas supply. But opinions are changing pretty quickly. Few nations are in favor of the war going on right now. Even fewer so are not speaking out. So we're seeing this again changing by the minute as more and more countries agree that Russia needs to see some repercussions for their actions. But I've talked a lot a bit now about Europe. I want to bring things back to the US. So let's get a little selfish and let's talk about the US and how all of this impacts us here, both our economy, because we need oil as well, and we are not immune to Russian oil, and the stock market. Elizabeth is saying, I heard US and Europe are in talks with Iran about supplying oil to Europe. Can you talk a little bit more about this? Yes. I can include that in one of my later slides where I talk about an organization called OPEC. So I will talk about it there. If I don't, just knock me over the head and remind me towards the end of the presentation. But yes, I will be sure to answer that. So again, let's bring things back now to the US and talk about how this affects us. Oh, the slides are out of order. There we go. So the US relies on other countries to meet our oil needs. We consume a ridiculous amount of oil. And yes, we do produce a lot here in the US, but we still rely on others to supply us with oil. Right now, oil comes from many places, but some of the main ones are our friends up north from Canada supply us with a lot of oil. Russia supplies us with oil, but only 7%. Compare that to the 40% in Europe. And this group called OPEC. It is the Organization of Petroleum Exporting Countries. It used to be OAPEC, which was Organization of Arabic Petroleum Exporting Countries, but then they started adding in other groups, such as Venezuela, that have oil and are not Arabic. So they renamed it OPEC. So we're not as reliant on Russian oil as the EU is. Compared to the 40% in Europe, we only rely on Russia for 7%. So that puts us in a really good position if we want to be hard on Russia and say, no trade at all with Russia. So this means that the US economy is a little bit more insulated. We're a little bit further away from this conflict. But the market has still reacted. The market has still felt the results of all of this conflict, but not directly. It has felt the majority of it through the investors. People like you, me, and Juan de los Palotes that are freaked out, having no idea what's happening, and are even more freaked out about what's going to be happening in the future. So let's get into the stock market. The market, going back just to the beginning of 2022, the market started off January very poorly, going down about 10% with high inflations because of concerns around Omicron, general market pullback, and there goes everything. There we go. And increasing tensions with Russia. Towards the end of January, we saw that the VIX volatility, which is the volatility of the S&P 500, or the fear index as it can be called, spiked up to a high of 32 on January 26th. At the same time, the S&P 500 ETF SPY hit a low price of $433, down from $478 just at the beginning of that month. So we're seeing almost a 10% drop in January alone. VIX, the fear index, was twice as high as the normal, which is around 15. So 32, over double the amount of volatility, or the amount of fear or uncertainty in the market. Now, things began to recover, stock prices began to go up, and as tensions in Europe continued to grow, volatility spiked once again. But this time, it was a little bit different. To show this more clearly, I want to go and look at the VIX chart. Here we see the VIX volatility measured by its ticker symbol, VIX, from around September of last year up to today. What we see is something pretty interesting. Volatility usually is it spikes and drops and spikes and drops. It follows the news. When the news freaks out about something, the market freaks out about something. Volatility spikes and then people calm down and it drops. We see that many times. We see here in September, volatility spiked, dropped back down, spiked, dropped back down. December, around Omicron, a very big spike in volatility, dropped back down. In February, a spike again. But what we're seeing right now is something different. This is not a spike so much as it is a constant increase in volatility. Things climbing just bit by bit every day. And it stayed high. Even today, when I wrote this presentation, which I tried to do it I made the presentation early but added the graphs late so I could give you as accurate of information as possible. The volatility had just dipped below 30. It has been above 20 for the past month. Now, this was an indication that investors were pretty worried about what might happen with this conflict, and were mostly just uncertain about what a war would mean for the US. For many of us, we don't know what a conventional war in 2021 looks like. We have never seen two superpowers with nuclear capabilities go into a hot war with weapons. And none of us want to. As fears around that being a possibility grew, investors started to panic, uncertainty went way up as people started to ask the questions, would the US go to war? Would Putin threaten to use nuclear warfare as a deterrent for other countries getting involved? And would Russia stop at Ukraine? Or if they captured Ukraine, push further into Europe? Those are a lot of questions of which none of us want to know the answers for. They are concerning, they would change the landscape. They would change everything about today's day and age. Even with how things resulted now, we are still living through history. This is something that will be something that is talked about for years. And when you don't know what's happening in history, you got to remember one thing. History is written by the victors. The side that wins is the side that writes that history book. When you have to ask these questions and you don't have the history books to know who won and who lost, it's pretty terrifying. The market showed that. So all we could do is wait. Go day by day, seeing how things shook out. And that led us up to this Thursday. Whereas tensions in Europe continued to grow, the S&P 500 continued to drop as investors started to fear and continued to fear a war in Europe. In total, the SPY ended up dropping to $422 on Wednesday night, which was 11% down from its high just 1 month earlier. And on Wednesday night, US time, Thursday morning in Europe, Russia announced that they'd began an invasion of Ukraine, sparking war in the country. So let's look at the first 24 hours, that Wednesday night, Thursday morning, and Thursday trading day, to see how the stock market reacted. Obviously, war just got declared. The stock market opened very down. The market opened 2.5% down, with SPY hitting $411 as investors panicked. Market volatility instantly spiked, hitting a high of almost 37. And then it stopped because the market realized something. The market doesn't fear bad news. The market fears no news. And it was strange to see. It was strange to see war unfolding in Europe and the US stock market taking off. All of those what if questions started to have answers. We started to see how other countries and our country reacted to the news of war. So as all of those questions started to become answered, we got this. No, the US is not going to war. No, NATO is not going to get involved with weapons. And hopefully, no, we're not seeing the start of World War III. Again, all of this is written as we know it today. I have no idea what's going to happen in the future, but I'm optimistic that the worst is behind us. And investors mostly agreed because Thursday closed high. By market close on Thursday, the market had recovered. It had picked up that 2.5% that it lost and actually ended up. The market profited on a day that war was declared in Europe. Technology and discretionary, the two hardest hit sectors as all of this news started to unfold, were oversold and very quickly began to bounce back. Volatility instantly fell, and the stock market was booming. But not before it bottomed out. Really quickly, right, where's my finger? Here. Okay, I'm really bad at trying to do this. Here. Those are the price changes from Thursday. Chip manufacturers, chip users, computer component manufacturers, AMD and Nvidia went up 6%. Apple, 1.67%. Facebook, Tesla, and Amazon, 4.5 to 5%. Microsoft beating them out at 5.1%. Technology and discretionary took off. But those are stocks. This is sectors made simple. what happened to sectors? Well, we actually know quite a bit about what happened to sectors because as part of what we offer here at Sectors Made Simple, we create a dashboard every single day that tells us what has changed in the world of sector rotation. We compare every sector against another to see who is coming out on top today. And because of this, because we follow these changes every single day, we have what yesterday did to the market. That's what it did. For those that might not be familiar about what the Sectors Made Simple data is and what it looks like, let me try and break down some of what we're seeing here. Momentum is what is changing. If sectors are gaining strength, they will have green positive changes. If sectors are losing relative strength, we will see negative red changes. X count, this column on the right here, or in the middle, I guess, is short-term strength. Positive trend is long-term strength. Remember those two sectors that I said did amazingly yesterday? Technology and discretionary. Technology is XLK. It lost 8 in total count. Discretionary lost 5 in total. 2 in positive, 3 in X count. Looking over a little bit, to the left, we see what is called BPI, Bullish Percent Index. It's a way of looking at a sector and saying how many companies in that sector are on a buy signal. The BPI is the percent of companies in a buy signal. The column is the direction. X's are going up, more companies are going on buy signals. O's are going down. More companies are going on sell signals. What we're seeing here is that the market bottomed. It hit the bottom hard. And as a result, almost every single sector lost short-term relative strength. Everything got weaker short-term. And 2 sectors also lost a lot of long-term relative strength, in addition to the market itself. Technology, XLK, and discretionary, XLY. At the same time, those 2 sectors also had the lowest number of companies on buy signals, with discretionary having only 25%, technology having just under 31%. That creates a pretty strong platform for things to bounce back. The reason that discretionary is here in green is because when things reach below 30%, they enter a range called oversold. That's where investors feel that we've sold off a little bit too much. We've gone a little bit too far. When things bounce back, they tend to bounce back stronger. So what our data shows was this. Every single sector's BPI was in a column of O's, with discretionary falling below that oversold line, technology just above that oversold line. And with the exception of XLC, all sectors lost large amounts of short-term strength. Technology and discretionary hit the bottom the hardest, but also are the ones that bounced back the most. Because by Friday, this was what the market in terms of sector rotation looked like. Every single sector saw positive price changes today. While news was coming out of Ukraine of war and battles, the US stock market took off. I also want to bring us up here. I want to bring up what the matrix looks like today. This is the changes in momentum for today's matrix. SPY gained, first off, nothing changed long term. All we see is short-term changes. Staples, which is a defensive sector, lost some short-term relative strength, while healthcare, technology, and discretionary improved, with technology gaining +6, discretionary gaining +8, and the S&P 500 itself +6 as well. Those are significant changes. When the biggest you can have, is 11, the smallest you can have is 0. +8 is 2/3 of the entire possibilities. That's huge to see in one day, and is a sign that they really did hit bottom hard, but have bounced back as well. So that's the US stock market as we see it through Sectors Made Simple's data. Let's now go and take a look, at Russia, because Russia does also have a stock exchange. We want to compare. How did the US do versus how did Russia do? There's no pretty words to say Russia's economy and Russia's stock market got destroyed this week. This is the chart for the Moscow Index, the Moscow Exchange Index, MOEX. Since the beginning of 2022, the market volatility has risen from 30. It has quadrupled to a peak of 130 on Thursday when Russia announced their attack on Ukraine. As a result, the Moscow Exchange Index dropped 44% in one day. It was so bad that the banks needed to place a restriction that prevented investors from short selling. They tried to remove the appeal. They tried to make it a little less pretty to want to bet against the market, because the market, almost half of the market just disappeared in minutes. Now, yes, we have seen some recovery. It bottomed out around 2050 and is back up to almost 2,500 now. But in that time, and still to this moment, some of the hardest hit companies were banks. Russia's largest bank by almost 4 times, Sberbank, I believe it's called, ticker symbol SBER, lost 47.6% of its value in 1 week alone. Not just because of the conflict in Russia, or between Russia and Ukraine, but because of the threats of removing Russia from SWIFT. There is no one that removing Russia from SWIFT would hurt more than the Russian banks and those that hold money in Russia or outside of Russia. So that's Russia. I want to bring things now back again to the US and ask the question that we really need to ask. We can't just enjoy the fact that the market's going up. We got to understand why has the market reacted positively. The simple answer is this. Many of the uncertainties around this conflict have started to be answered. We know, will the US get involved with troops? Will the US put sanctions on Russia? What will the sanctions be? Who will join? What's China going to say? What are other global superpowers going to say? The more answers we know, the less uncertainty there is. Now, international cooperation, this idea that everyone in the world is working together, is happening, where international countries are pushing back against Russia. And I did the wrong thing. Here we go. They're pushing back heavily to show that countries are not afraid to hit Russia monetarily, even if it means short-term damage to their own economies. By Friday night, Putin had made an announcement that he has interest in meeting with Ukrainian leaders to talk about how to proceed. Because as Russia gets hit with more and more of these sanctions, there will be more and more pressure on him to make a decision to protect the economy of Russia. So, what happens from here? No one really knows for sure. That's kind of the thing. We're still not really sure what all this means. So, let's look at history to try and understand a bit more of what might happen. I want to look at some data about the market and how it reacts to world events, but more specifically, two types of world events. Kiplinger, which is a great resource for financial data and analysis, put together a list of world events, and then how the S&P 500 reacted 1 month later, 3 months, 6 months, and 1 year later. Instead of just showing you the big table of things, I wanted to simplify it. I wanted to make it into something that is much more on topic. So I only took two types of events: declarations of war and oil crises. So let's break this out. First, talking about the wars. So what you see over here is a table of wars in the past 80 years and how the market reacted to them. For the most part, short term, the market gets hit. 3 months flattens out, 6 months profit, 12 months profit. What? If we're going into wars, or if wars are happening in the world, you're only really seeing the market get hit by that for 1 to 3 months? That's weird. But outside of 1 or 2 big ones, and by those I mean outside of the Iraqi invasion of Kuwait and Germany invading France, which was one of the initiating events of World War II, the market recovers quickly. Now, this Yom Kippur War, that stands out as the only other one alongside the instigation of World War II, as it did not recover. It got hit very, very hard in the 12-month category. And that's because it overlaps with this event that I want to talk about now, which is oil crises. Back in 1973, Israel went to war, and as a result of that war, OPEC, the Organization of Arabic Petroleum Exporting Countries, wanted to put their foot down and say, we're not okay with what's happened. So they put an embargo on any nations that helped Israel and said, we're not going to sell you any oil. So what did that actually do? Well, again, this is the only time we've seen a large-scale oil crisis. And that embargo lasted only 6 months. But in that 6 months, it saw the U.S. really get hit hard, where we had gas limits. So if you went to a gas station, you could only fill up 10 gallons. There was only so much gas and oil that you could consume in a certain period of time. It was really bad. And if you thought that those events were bad, keep in mind that at the time, OPEC only accounted for 19% of the US's oil consumption. But in those, as a result of that 6 months, It erased 7% off of the S&P in 1 week. Or sorry, 1 month, 13% 3 months, 14.4% 6 months, 35% in 1 year. So there was a question before about, where was it? It was, I heard about the US and Europe are in talks with Iran about supplying oil to Europe. Will we see that? Probably. Probably, but it's going to cost us more. Keep in mind, OPEC exists for one reason: to make it where countries are not competing against each other to see who sells the cheapest oil. If all of the countries agree, this is what we charge, this is how much we produce, they get to decide the price by saying, here's how much you need, here's how much we'll give you. Fight. We're probably going to see that. OPEC is in a good position here because they now are the world's largest supplier, or they were, but they still are going to be one of the only sources of oil that Europe is going to have access to. Much higher demand, but OPEC decides the supply. So it's up to them where they want to go from here. So what does this mean now for the US in 2022? Well, we can look back 50 years ago and see that when the US gets cut off from our oil, the market suffers significantly. But we relied on OPEC's oil 3 times more than we rely on Russian oil. So will we see 1/3 of the losses in the market? No. But it's also too early to say. We have many more options. But 7% is still 7%. But Europe does not have as many options. Remember that 19% number that damaged the US economy 34% in 1 year? Yeah. Try doubling that, and you get into the situation of many European countries. So while it's too early to tell what the long-term impact is going to be, in the past 2 days, we've seen the price of crude oil from the Brent crude oil prices rise by 2.3%, reaching its highest levels since 2014. And we're still only in week 1. So where do things go from here? Well, again, if you are in the US and you're looking at this as a US investor, we're going to be largely insulated. We're not going to feel a lot of the economic effects of these embargoes. We are not in the top 10 exporting countries for Russia. We are not going to suddenly have to start rationing our oil or our gas consumption because of this decrease. But it will cost us more because we need to get that 7% from somewhere, be it Canada or OPEC. And if there's no resolution of this conflict soon, the US is not going to feel it first. Europe is. Because Europe, again, relies on 40% of their oil coming from Russia. They might see gas shortages. They might see significant increases in energy prices, oil prices, and maybe even rationing, depending on how bad things get and how long these shortages last. In my opinion, what we are seeing right now in the US stock market is not optimism about the future. It is a correction because the worst case scenario didn't happen. That's not a reason to celebrate. We are not in a position to be celebrating and being optimistic. We are living through a war. And yes, the war isn't as bad as economists thought it might be if the US got physically involved, but it's not good. None of it's good. So I don't think what we're seeing right now is the new uptrend in the market. It's just investors realizing, okay, well, the world didn't end. We're not in World War III. Time to buy back Facebook. Looking, again, back at what's happened in the past to try and get an idea of what might happen in the future. When it comes to war, the stock market is largely indifferent. It will go down short term, but it'll recover within about 6 to 12 months, and you'll see profit. The one time oil has gotten mixed up in a war, though, we saw pretty heavy losses. Will we see similar losses? Probably not. Our economy is not as reliant on oil, Russian oil, as it was reliant on OPEC oil back in the 1970s. But only time will tell about how long this conflict is going to go on, how major nations' economies are going to be affected. Europe much more so than us. And again, money cannot replace lives. And the unfortunate thing is, the biggest question here is how many lives are going to be lost because of really greed. I want to bring things back to the Middle East and just how important oil is as a bargaining tool in the world. There's a documentary called Who Killed the Electric Car? And it talks about the first electric car that was released over 40 years ago. This electric car was fully electric and sold like hotcakes in the US. People were incredibly excited to get away from oil and our reliance on oil. The US government was so concerned that a decreased US reliance on foreign oil would destabilize relationships with the Middle Eastern countries, because that's how important oil was to us. We were worried that the results of that would have caused a war. So instead, the US decided to buy up all of those electric cars and destroy every single one of them. We rather would do that than risk lowering our dependence on foreign oil and destabilizing relationships with the Middle East. Oil is a natural resource, but is also one of the biggest bargaining chips in the world. The US knows it, Germany knows it, the EU knows it, and Russia knows it. So we're going to very much see oil and energy be at the center of this all. Elizabeth's asking if cutting Russia from SWIFT will hurt other countries. Most definitely. Because again, it's not going to hurt them monetarily, it's going to hurt them because SWIFT is how money is transacted between countries. If SWIFT gets cut off, that means that Russia can't accept foreign payment for oil. So exactly that. It will affect Russia's ability to trade with other countries, with the predominant export from Russia being oil. So yes, will cutting Russia off from SWIFT hurt other countries? Most definitely, but none more so than Russia itself. Russia is not a powerhouse when it comes to GDP per capita. The average person's quality of life is nowhere close to what it is in the US or other European countries. So it's going to hurt them significantly, but it's also going to hurt European countries significantly, which is why countries like Germany were so reluctant to put that up as an option. But as we've seen today, those opinions are very quickly changing as the situation in Ukraine gets worse and countries realize that something needs to be done before nothing can be done. I wish I could end things on a brighter note and a more optimistic note, So I'm going to plug this one more time before I call today's webinar. This is a organization, CARE, that is raising funds to support families that have been displaced in Ukraine as a result of the crisis. I'm not going to ask you to go donate, but if you're wondering what you can do to help, putting your money towards a good cause, especially one that a large amount of the proceeds do go to the cause itself, is sadly the best that we can do in our position. So thank you all so much for joining us today. Again, I wish it was on better terms, but we're living history, and the best we can do is keep a close eye on it so that we can understand what it means, and most importantly, how we can move forward. So thank you all so much. If you have questions, you can always email us at support@sectorsmadesimple.com, and we'll see you all back next week with hopefully brighter spirits, brighter news, and a brand new topic to help you understand the market simpler. Thank you all so much. Take care. Stay safe.